I'm here with Jeff Wilson. He's the head of asset allocation at TD Asset Management, overseeing about $70 billion in assets, and here to talk about the surprising, some would say stunning and shocking outcome of the US election. The polls didn't predict this, media didn't predict this, and we saw the markets had quite a reaction when the news first came out. They seem to have moderated somewhat right now, but what are your thoughts when you're in the business of preparing for these kinds of outcomes?
Well, I think there's a knee-jerk reaction, but through the whole campaign it was a roller coaster, and there's always a possibility, and so it was always kind of in our thought process that what happens if Trump wins. And from this point, kind of looking forward, the knee-jerk reaction is a negative. It's negative for trade. It's negative for the trading partners, particularly for Mexico. So the Mexican peso is off about 8% this morning. And I think that's going to continue to weigh on Mexico. For Canada, I think it's kind of a wait-and-see perspective. But for the U.S. economy, it's looking like a deglobalization, which very long-term may be more positive, but in the near term, there's an adjustment process that people are kind of expecting. So that means, perhaps a slower economy in the next year or so. Which
I would obviously, trickles off to everybody in the world, quite frankly, when you've got one of the economic engines having slower growth. Let me ask you, I think, you articulated well about this deglobalization and what this means, but the adjustment process, what are you looking for in this adjustment process? What are you paying attention to?
Well, I'm going to focus on the positive. The trade is the negative side, and that's, negative for a lot of different people in a lot of different countries in the world. But from a positive perspective, it probably means more domestic jobs, more in the infrastructure area. So from our perspective, we start looking at where is that infrastructure going to come from, and who's going to support it, and who's going to benefit. So which industrials, so we probably focus a little bit more on the industrial sectors of the U.S. economy as maybe getting some support here.
What about Republican leadership? I mean, this was contentious to say the least. In terms of the adjustment on the political side, what are you going to be watching for there?
So I think there's a few things that the president can do on his own, and so related to trade. But in terms of tax policy, that he's got to work very closely with with Congress, and particularly Paul Ryan as Speaker of the House. He's going to be the one that needs to promote an agenda. So I think from my perspective, one of the things I'm going to be very closely paying attention to is what comes from Paul Ryan as what he wants to accomplish, because you've got Republican control of the House of Representatives, the Senate, and in the White House when Trump moves in. So from that perspective, in theory, you've got Republican across the board. They can set an agenda and push it forward. But in some respects, Trump is a party unto himself, and he has a different agenda than Paul Ryan, and so how those two work together, what the dynamic is, and what one wants to accomplish, what's the other accomplish, and whether or not they can come together. And there's certain factions, the Tea Party faction of the Republican Party may get, have their own agenda, and they may, promote different things. And so having it all come together is really, kind of let's wait and see what happens there.
Yeah, it's going to be one heck of an adjustment process, I think, on a bunch of fronts. Let me ask you, from pulling up and taking a look at the markets and from the asset allocation perspective, what broader changes did you do when you were looking at asset allocation moving into this uncertain time?
Well, I think from our perspective, when we want to be tactical in this environment, we can use options to a small extent, but realistically, with the outcome so uncertain, the key thing for us was let's raise a little bit of cash, let's get a little bit more defensive, let's get underweight equities, and let's reduce the overall portfolio volatility and see where the opportunities come. One of the things that becomes a little bit more difficult from an asset allocation perspective, typically we're looking at bonds versus equities, but this is going to also be difficult for bonds because the term premium will rise with the uncertainty, and not sure what's going to happen at FOMC meetings and how that discussion is going to go, and some uncertainty there because Trump has indicated that he wants to make some changes at the FOMC level and maybe bring in somebody different. So a lot of uncertainty there, and not necessarily bond positive.
You mentioned industrials looking like they could be an opportunity based on infrastructure spending, the fiscal side of things. What else do you see as potential opportunities? And again, I'm really cognizant of there's a lot of adjustment happening right now, so a lot of it's going to depend on what we hear over the next little while.
Well, I think from there you start drilling down to company specific companies that, like if we think about steel companies, for example, they've had a lot of pressure from China and China coming through Vietnam and dumping steel onto the U.S. market. And at this point in time, you've got to expect that somehow or other there's going to be greater protection for that industry. So even though the industry's been challenged from a profitability perspective, the outlook actually looks up a little bit. And so and from a high yield perspective, they may be looking at those bonds a little bit differently today.
Healthcare? Obviously people were concerned about Clinton policy coming in on healthcare stocks, but at the same time we don't know what's going to happen with Obamacare overall.
Well, I think for healthcare stocks in general, I think there's going to be a little bit of relief, and so there'll be an initial rally. But after that, what happens with Obamacare? The Republicans have been reasonably quiet on that one, and so a couple years ago, there would have come straight out and said, "Let's repeal Obamacare because we hate it," and that could happen. But they may just make some adjustments on the margin. And again, let's listen to what Paul Ryan has to say, because that's really going to be the key to what the future holds for Obamacare.
If you were to take this up from, like I said, to a meta perspective, I guess both politically and from an asset allocation standpoint, what do people need to keep in mind?
Well, I think at this point, you look at the quality companies that you have in the portfolio and say, okay, well, the quality companies will continue to do well, and so we'll emphasize quality. Dividend payers should continue to, benefit from the cash flow that they're generating, and I think broadly speaking, the roadmap will unfold over time. But having some patience and investing in quality companies is going to be the key to success here.
Jeff, thanks very much. That's Jeff Wilson. He is Head of Asset Allocation for TD Asset Management. I'm Kim Parley. Thanks so much for watching.